Welcome to CRE360 Weekly Market Intelligence. In new format but same mission, to bring clarity to commercial real estate. Every week we will track how capital, construction, and risk move together, and what that means for anyone who builds, finances, or invests in real projects. No noise, no narratives, just systems that move the market. Let's start where every decision begins, the cost of money and the mood of capital.
This week, markets fully priced in a 25 basis point rate cut at the upcoming October FOMC meeting. SOFR eased to 4.13%, reflecting increased confidence in near-term Fed easing. Treasury yields held steady, 2-year at 3.60%, 5-year at 3.74%, and 10-year near 4.14%, signaling stability at the long end. Meanwhile, credit spreads widened. Better Business Bureau option. Adjusted spread rose to 0.98%, and high-yield option adjusted spread 2.95%, as investors grew more cautious on credit risk. The CME FedWatch tool shows nearly 100% probability of a rate cut, and futures imply SOFR around 3.6% 1 year ahead. Liquidity is returning, but confidence remains cautious.
This week felt like the market taking a deep breath before the next move. With the Fed set to ease the rate, disciplined borrowers should use this window to lock refinancing or extend duration before the spreads widen further. When Fed and the bond market start moving in opposite directions, opportunities open, but only briefly, because rates are easing but spreads are not. Next, we will see how the cautious is shaping real lending behavior across construction and credit pipelines.
This week's credit markets continued to firm. Commercial mortgage-backed security conduit. AAA spreads tightened to about 78 basis points over treasuries, their tightest level since early 2024. Commercial real estate collateralized loan obligation. AAA held near 130 basis points, range-bound but stable. Senior loan spreads for core assets hovered around 170 basis points, while construction loans averaged 450 basis points over SOFR. All-in mortgage coupons. Conduit approximately 6.6%, life companies approximately 5.9%. Underwriting remains disciplined, DSCR approximately 1.8 times, loan-to-value approximately 57%, debt yield approximately 12%. 85% of new issuance includes interest-only periods, mostly partial. Origination volume plus 35% year-to-date, led by multifamily and industrial. Credit is available, but selective.
Credit desks are tonic, but discipline still rules. Think of liquidity as a bridge with weight limits. It can carry capital gain, but only for those who can meet the standard. Borrowers should lock in midterm paper and structure partial IO to protect cash flows. And lenders can lean in on core assets but must price risk honestly as refi demand builds up. Rates are easing, but credit is not generous, and that gap rewards preparation, not hope. Next, we will see how this selective liquidity is reshaping valuation and where the price discovery is settling finally.
CRE valuations are stabilizing. The all-property cap rate equals 6.8%, steady since late 2024. Multifamily and industrial lead recovery, approximately 5%, while office and retail hover mid-sixes. Green Street CPPI, plus 2.9% year-over-year. MSCIRCA, plus 2.4% year-over-year. First synchronized increase since 2022. Cap rate treasury, spread equals 270 basis points, stable and healthy. Appraisal values remain 10 to 20% below 2021 peaks, but discounts have stopped widening.
Price discovery is near complete. Buyers and sellers are finally meeting in the middle. Values are settling like the concrete after a long pour and forming the base for the next phase. From here, growth won't come from cap rate compression. It will come from income expansion and execution. In construction and cost, we will look at what happens after valuations are stabilized and where the market's next battle is being fought. Because developers aren't negotiating price anymore. They're negotiating feasibility. Because in this cycle, risk is not overpaying. Risk is overbuilding at the wrong price.
Construction cost momentum remains slightly upward. Turner Index plus 3.8% year over year. ENR 20 City plus 3% year over year. Steel plus 6%, aluminum plus 20%, lumber minus 5%, concrete flat. Labor plus 4.4% year over year. ABC backlog equals 8.5 months. 25% of contractors report delays tied to financing or procurement. Inflation has plateaued, but relief remains elusive. Construction cost momentum remains slightly upward.
Costs are stable at the top, but not falling enough to restart the pipelines. Think of it like an engine idling hot, not racing, but not cooling either. Developers must lock key materials early, structure contracts carefully, and keep 7 to 10% contingency. Labor pressure is steady, so timing is everything. Next, we will see how this elevated cost and tighter budget shape capital flow and refinancing risk.
U.S. CRE liquidity rebuilds. MSCI sales volume approximately $420 billion plus 13% year over year, led by private buyers. Distress equals $115 billion, half in office. MBA, nearly $1 trillion, CRE debt matures through 2025, peak before easing. Cross-border equals 5 to 6%, lowest in decade. CRE-KIN, $131 billion raised, minus 30% year over year. Dry powder equals $350 billion, still strong. Distressed sales approximately 3% of total. Liquidity exists, conviction lags.
So liquidity is back, but conviction is not. Capital is convey moving again, but the toll booths are still mad. The best trade now are recaps, pref equity, and rescue loans. With $1 trillion maturing debt and $350 billion equity waiting, this phase is about timing, not volume. We're not short on money, we're short on clarity. When pricing meets conviction, volume will return fast. Next, we will take a look at insurance and risk in CR.
Global insurance pricing softens. Marsh, property premiums minus 4% year over year, fourth straight decline. US P&C loss ratio equals 96.4%, best in 15 years. Local Law 97 enforcement begins. 30-plus cities now have building performance rules. Approximately 50% of Class A offices green certified. LA, Boston, NYC expand adaptive reuse programs. Insurance costs ease, but ESG and regulation rise.
After 3 years of spikes, insurance finally normalizes. Feels like blue sky after a storm, but the ground is still soaked. Because savings most likely will shift to compliance. Model lower premium, but budget higher for ESG upgrades. In 2025, resilience is underwriting adaptive assets. That's this week's CRE360 Market Intelligence. Starting next week, we will touch all properties fundamentals. To access the full weekly intelligence pack, including data, tables, sector dashboard, and visual reports, subscribe at CRE360.ai. For customized analysis or reports tailored to your capital or development strategy, contact us directly. We will help you structure clarity into every decision with the right data. Have a wonderful week.